Hi, this is Sean Overton from OneStepRemoved.com. In this video we're discussing my failed trading experiment. In the last video I went over the idea of how you would expect to neither make nor lose money using different stop loss and take profit settings. In this video I'm going to go through the idea of how I actually expected to make money from trading at random. The idea was dependent on NB Trading's pay for limit program. If you enter or exit a trade via a limit order, they'll give you a commission which works out to $19.95 per every 100K, or per million. But if you trade a market order or a stop loss, then they charge you a commission, and that works out to $29.95 per million. So I normalized it down to a micro lot level so I could trade with a friendly experiment and not have to risk very much money. And then I multiplied it by 1.3, which is the amount notional that you're trading on the euro dollar in US dollar terms. So if you don't understand that, that's fine. The takeaway is that the limit income that you get from trading the euro dollar works out to 2.5 cents at the current market price of $1.30 on the euro US dollar, and the current commission on the stop loss is 3.8 cents. So you make 2.5 cents, but you pay 3.8 cents. Now, with the different settings that I had used, what I was trying to do was to engineer trading with a limit order so often that I would make more money than I would spend. And the goal was just to suck up all of the different rebates from the limit orders. So if I traded a system that had a stop loss with a 20 pips and a take profit with 3 pips, my payoff is 1-to-1, and I don't enter with any rhyme or reason, then I expected to come out at 0. But I'm earning commissions while I'm doing this, and I'm paying them. Now, we're going to look at the exits first because that's a little more logical to break down. So here we have 87 wins, which means when we win, we're exiting by a take profit. So we multiply that by the amount of income that we expect to make. So just from exiting our trades at a take profit, we expect to earn $2.20. Out of 100 trades, we expect to lose 13 times. And if we lose 13 times, we only pay this 13 times, which works out to a total of 50 cents, almost exactly. So from the exits, we actually net $1.70. And then the cool thing on top of this is that here, we're actually, if you enter by a limit order every time, you would get this times however many times you entered. So if we did this trade 100 times, which we enter by limit 100% of the time, then you make $2.53 on the entries, and you lose, and I'm sorry, you also make $1.70 on average per 100 trades on the exits, so you make about $3.23 trading micro lots, which is pretty darn good. You make about 32 pips, and you could do it in a couple of days, but you don't have to take any market risk. You basically just provide a liquidity business. I thought I was very clever by coming up with this, and I thought, wow, this is a great idea. I'm just going to run it. Now, this is where it all falls apart. This is not a substantial return, but it's a return, and it's something that you would expect mathematically. The problem was that my assumption that I'm going to win 87% of the time entering by a limit order didn't hold up. So when I entered with these settings on the euro dollar, I would pick my direction with random numbers, and what I found was that this percent accuracy was dramatically less than what I expected. So this is all the hypothetical, and in my real results that I had traded with live money, what I found was this worked out to something like 81%. This worked out to something like 69%. This one came out about 62.5%. And this one came out at exactly 50%. You run the numbers, and this doesn't come close to overcoming the losses here because I'm not winning enough to get to that 0 number that I had expected. It's not because of the spread, because I'm earning the spread when I enter via a limit order. It's not because of some flaw in the strategy, it's just random numbers. I literally was just picking with random numbers. So there's something about trading in the market and entering via a limit order that changes the conditional probability. I have not come up with a reason or a solution why that is, but it does seem to be the case. I have a live trading account and losses to prove it. And this was, and I just to give you some more confidence in this, I didn't do it for just 30 trades and give up. I let it run for about 120 to 150 trades for each of these settings, hoping that eventually I'd settle on something that made sense. Well, unfortunately, going below 50 doesn't, because the amount of income that you are earning from the limits, this idea no longer applies, and there's something in the probabilities that changes just by entering with a limit order that makes this whole idea fall apart. Lesson learned, it's something interesting, so it goes. It's the way it works when you're trading. If you have any questions on this experiment, you can find me at www.onesteppermove.com. My name is Sean Overton. Thank you for listening.